just entered the trading pit, your home for sophisticated takes on the crypto markets. It's March 26th, and here in the studio is JJ and Ben Lilly of J Labs. I am your host, Marconi White, and Bitcoin has denied the bears a fresh lunch and is back above 70K. We're going to unpack what's driving price action, but first, it's rapid fire where I ask these guys to answer ridiculously simple questions. Or rather, give ridiculously simple answers to impossibly complex questions. Okay, there we go. Got it in. All right, JJ, we're going to start with you. Cathy Wood thinks 1.5 million Bitcoin. Is this bullish or BS?
What was her time frame for that?
I didn't say. I'm not sure she did either.
I'll say BS.
Okay, all right. We're starting hot. Cathy, you're welcome on here. You're welcome to come on and defend 1.5 million. All right, Ben, Pendle or Ethena?
Pendle.
Oh, coming out hot. I don't know why. I mean, we're gonna unpack a little bit of that DeFi stuff in a moment because I want to know where that's going. All right, JJ, Ethereum 2K or 6K first?
I actually hope I'm wrong, but 2K.
Oh, man, you're gonna crush some hearts in the audience there. They may be coming after you on Twitter. Ben, does Powell cut or not cut next round?
He does not.
He does not. Regardless of what the LLM and they're saying about the AI is saying about what he just came out with. Okay. JJ, last question here. GBTC, does the bleeding stop when they hit 20 billion or 10 billion AUM?
0. The bleeding stops at 0.
You went off script on that one.
And it go negative.
Oh my gosh. Well, we have seen the NAV premium go negative. Okay. All right. So there you have it. For all the people that want some predictions, we just gave them to you. And of course, they're going to be 100% correct, as all of them are. I do want to get into the Bitcoin price action. But before I do that, I want to touch on something that hasn't gotten much love this cycle, which is DeFi. Ben, we've seen all the momentum thus far really go into AI and meme coins. They have just absolutely rocketed forward. And yet DeFi has seen very little traction. So for example, I looked at Render this morning. It's up 800% since May of last year. Pendle, on the other hand, my numbers are correct, it's just up 100%. So I want to ask you, what is your perspective on the potential for DeFi this particular cycle to outperform?
Well, you're talking cycles, so that's a pretty long time frame. And considering what has already moved and made those moves, historically, like I was just listening to, Blockworks, they put out good material. Their research group was just talking about how, Rollbit and Unibot and some of these other early projects have lagged considerably. And moving forward, I wouldn't be surprised to see some of the early movers over the last 3 months lag on the next move that the market decides to make. And when we think of DeFi, I could see essentially a 3.0 type of catalyst for DeFi to come back and reinvigorate that market and kind of bring everybody back and get all excited again.
Okay, so reinvigorate. I guess a question from an investor perspective, so much of the attention right now, as I mentioned, is on AI and gaming. Is now a good time to be looking at some of these DeFi projects, to be looking for positions without giving out specific ones right now?
I would say that right now, if that is new territory for you, you do need to do a little bit of homework, do a little bit of research right now, understand the evolution taking place on Ethereum, kind of see what's coming down the pipeline and see what kind of these derivative markets are doing, because that will then lead you to what projects to really focus on. I mean, we see what's happening with Pendle. If you don't understand what's happening with Pendle over the last 6 months, it really would behoove you to go ahead and take the time to learn about that market. There's more coming that are similar to that as well. So that this market is just going to heat up in the next 6 to 12 months.
It'll give you plenty of things to discuss on the interest rate front, which I know is one of your favorite topics. So we'll definitely have to come back and discuss DeFi. All right. Well, I want to get into the price action here. Before I do that, I want to say welcome to Light Signatures, Paul J, Gabrielle, Preet, G-Man, and Malay Tusum. That's a new one. Who correctly pointed out that it was Cathy who said it was over a decade that we get to 1.5 million Bitcoin. But welcome. Glad to see you here. What's that?
I'll agree with her on that. I wasn't.
You agree with her on that one?
Year, so yeah.
Okay, so Cathy, you don't need to come on and explain your reasoning here. All right, so let's get into the Bitcoin meat. Last Friday, Bitcoin was trading in the low 60Ks. And over the weekend and into yesterday, it shot back above 70K. I think this morning I saw I was just sitting about 70,700. But when I looked at some of the charts, spot volume did appear low, but the Coinbase premium is still around. And we just had a massive outflow on the ETFs. I think I looked at the number, it was about 887 million. And yet we still see open interest going up. So we're seeing a lot of mixed signals. So JJ, I want to ask, right now, when you're looking at this pump, taking us all the way from lower 60 to 70K, do you believe it? This is sustainable.
I don't. I think it was a short squeeze. So the 100x leverage that have entered within the past 2 weeks, and we see over the weekend and Monday, we basically came up and cleared out all the leverage that was left over from the pump to 74K a couple weeks ago. And now we have a whole lot of long leverage down below. So it's really going to be dependent on spot flows today and through the rest of this week to sustain here. I think the downside's looking a bit slippery. It seems like they just kind of took, there's a moment in time where price action was looking weak, shorts crowded into position, and it became extremely easy to pump it up. Powell gave some dovish comments over the weekend, and Bitcoin used that as an excuse to pump up and basically liquidate every short that had been opened over the past week. But now it seems like it's looking a bit heavy. So depending on spot flows today, obviously, I think we're looking due for some mean reversion here.
What does that mean reversion look like in your mind? We talked before about something going all the way back down into the 50s. I looked at the options market this morning. I think the max pain point for this week's expiration is 50K. How much of that do you think factors into how low we may go?
I wouldn't rule out, let me pull it up here. So the 50-day moving average, which is currently at 59.6. So I think that's a logical spot to test. If we do, like obviously if the 70K momentum holds, spot bids come in, we could keep going up, right? But I'm just saying, looking at it right now from this perspective in this moment, I think we're looking due for some mean reversion. And obviously, if we do start to mean revert, we lose the 2021 all-time high at 69K, then you start to look, okay, where's support here? Probably won't find it again at last week's lows. Odds are we'll wick below that. And the 50-day moving average seems like a logical first spot if we do start to see downside manifest here again in the coming days into the end of the month. So this would be kind of target number one, say if 69K doesn't hold in the coming days.
Okay. So definitely this week and the next couple of days, we need to continue to see some of that momentum. Ben, I want to ask you a question. I did mention before about these ETF flows really coming down. Last week was, I believe, the first week of net inflows going out, 870 million. Obviously, all of that was really driven by the sell-off for GBTC. And yesterday, if my numbers are correct, we had just 15 million coming in. Is this the start of a slowdown in these ETFs? Is just expected activity? What's your sense here?
With ETFs, you take it as the data comes in. Projecting forward, I think is, a losing battle because you're going to form a bias if you're wrong. Like what JJ was mentioning with the 50-day, the 200-day, 200-day seems way off at the moment. So just focusing on what's going on the 50-day makes a lot of sense. I have on my screen, I pulled up, this is something we've been working on for a while at the lab. And at the bottom, you can see this is cumulative volume delta broken up into various demographics. The green is your retail. These are very small orders. And they're not really making moves here in the market. It's going to be more of the larger demographics. This is like 10,000 to, I think, 1 million orders. You can see they have been very active in this rally. And then when it comes to the million plus order base, like they've kind of made their move very early and they kind of stayed stagnant. So if we kind of keep this in mind, that this demographic is the one that's going to start to move things on the order front, pulling up our bid-ask ratio, you can see it's not looking favorable at the moment, which is in part because you're not seeing those demographics go ahead and crush the order book. So you're getting a little supply overhang right now on this most recent movement. That's what all those red bars on the subplot represent. It's just that the amount of sell orders existing on the book are far outweighing what exists on the buy side. So you have to have those demographics that I pointed out before essentially taking out those orders. And if you don't see them active, who's taking it out? And so getting back to the ETF flows, that's a pretty significant move. that we're seeing in terms of just the negative net flows all last week. And yesterday we didn't really see much. It looks like 15 Bitcoin on the net, which is not a great way to start the week.
15 million in Bitcoin. Yeah.
Correct. Sorry. Yeah. 15 million in Bitcoin. And so GBTC is still outflowing. They tend to start the week off pretty hot as well, and it tapers on. So where's this coming from? That's a big question mark for me. If it was a gamma squeeze as JJ hit on, then that's just really, exaggerated price action that happens, but then you still need to have a follow through. And so we have to see that come into the market today or tomorrow.
Yeah, we did see that a bit yesterday. Like as we reached the 68K level here, which you see was pretty substantial dealer gamma. Price just basically shot straight up to 70 within, I think it was like an hour or so. But then once we got to 70, like what you would want to see there, because there's even larger dealer gamma at that level, would be priced to just basically shoot up to 72K. But since there was so much supply that was anxious to sell at 70, it kind of muted that move of dealers to stay delta neutral. So although they were adding longs, you had a equal amount or larger amount of people selling. So that kind of prevented price from really making that same move that we saw when dealers got gamma squeezed at say 50K. And we basically went to 62 or 64 within a day or two. So that seemed muted just because there was that supply overhang that Ben was talking about. So there was the potential for a larger gamma squeeze. There still is if we get these ETF flows and they just run over the order books here in the next couple of days. But it seems like there's more sellers than buyers currently at this level. It seems like a distribution pump, which we mentioned about a week ago. We were saying, hey, like, yes, it's looking bearish right now, but they always paint the charts to build more liquidity. So they want you to be buying at these tops. And then obviously it reverses and you're kind of stuck in position. So be aware that this is kind of, it looks to me like chart painting for now. It seems distributive.
Okay, so we're seeing a couple of signals that suggest that this pump is not going to be heavily sustained unless the ETFs really pull us through. I know this is the end of the month, and we talked several times in the show about the rollover that we expect to see from TradFi, which is hedging its positions for the ETFs. I guess, JJ, from an options perspective, are you seeing any changes in the calls and the puts and the interest that's suggesting that people are positioning for some turbulence going into next week?
Yeah, we've actually seen some put buying here in recent days. Let me pull it up. So you see for March 29th expiry, this has basically been all puts, especially for the past day. It looks like about around 2,000 puts have been added within the past day here for this Friday's expiry. If we go out to April, same thing. So you see since March 25th, there was 21.8 KBTC of open put interest. And now that's almost at 26. So about 5K of puts added to the March 26th expiry. Seems like the market's kind of bracing for the downside and they're taking this pump as a means to get cheap puts, right? So when price is up, obviously that put premium drains. People think the bottom's in, and you could buy that insurance to the downside rather cheaply, which I'm sure we'll talk on later in the show. We'll look at some of those contracts, but it does seem like the market's hedging itself pretty substantially here. So be aware of that.
So the options market is buying some protection to the downside as it's come in cheaper on this pump. Is it possible that was the whole point? This was engineered so they could come in here, buy some cheap insurance before it drops?
It wouldn't surprise me if it was. That's for sure.
So what do you make then? Because I was looking at some numbers earlier this morning before the show. The long shorts are still 56 to 43%. I'm looking at that thinking, okay, well, they're more positioned from a long perspective, and yet people are buying up options. How do you reconcile those two patterns?
It's hard to say. Like, obviously, people could be entering long positions for any number of reasons. It could just be price-based speculators. People could be long perps, short, or long perpetual contracts, and then you buy puts to hedge that. So there's any number of ways the market in mass could do it. It just kind of, you take the accumulation of those signals and try to make a reasonable conclusion out of all of it. That makes sense.
So nothing really to tell you that anything more than the fact that we've got a couple of ominous signals right now suggesting that we could see some turbulence going to next week. The options market is preparing for a little bit more downside, and we're not seeing anything too convincing. So really all eyes are primarily on the ETFs. I know we'll get to the Dixie in a moment because that seems to be the outside risk that never seems to reveal itself.
The biggest
But,
thing I look at is like, I mean, this is one of my favorite indicators is just these liquidation charts. So we always say how the market moves in the path of least resistance. And obviously last week into the weekend, there's a whole lot of shorts entering positions, which just makes it super easy to move price up. Because as we kind of explained previously, when people get their shorts liquidated, it turns into buying power. That pushes price up further. And then if you're looking to de-risk spot, you could do it at a lot higher price. So it just seemed like it was some liquidation games going on there, rather than some kind of real catalyst buying coming in.
So JJ, kind of last question I want to ask here, and maybe Ben, if you've got something you're going to bring in, but in your mind, what signals would change for you to be risk on, right? You talked about the liquidation pools. We talked a little bit about the ETF flows. We talked about the options positioning. We go into next week. Let's say the turbulence isn't as bad and the volatility isn't as bad. What signals are you looking for to be more risk on, to think that this pump to 70K can be sustained?
If I saw the New York session bid us up above 72,000, 72,500 or so and hold that level during the New York session, I think that's bullish, and you don't fight the flow in that scenario. I think that's just a sign of pure ETF demand, price insensitive ETF demand, and that's going to go a lot higher if we get above there. So I think the invalidation is so close that I think it's worthy of being bearish here, just for this $1,000 to $2,000 range, and see if price doesn't mean revert here in the coming days. But I think that's kind of my invalidation line in the sand, would be above here, like 72.5 or so. We start catching momentum, especially during the New York session, led by obviously ETF flows. You can see that coming in the tape, and above that level, you don't want to fight it.
Ben, is there anything you would add to that you're looking for to validate that this pump can be sustained?
I'd like to see the Coinbase premium show its head again. Like right now, was it like $10 right now? It's nothing significant, and here we are right at the open. And if we can see a significant push on the premium over the next hour, that'd be a positive sign here that there are going to be some flows coming in for today at least. But if we don't have any follow through, especially like at the lunchtime 3 o'clock time frame as well, like that's a little bit of a warning sign for me that we're not getting that follow through on the book that we want to. As far as like time zone relation, that's always important to watch out for, because like right here, you can see the P&L based upon the various sessions. You got the Asia, Europe, and USA session, and the red line is USA. You can see that October, November in 2023, it was leading the charge with, fury essentially. And whenever you have that lagging and you kind of have the other sessions starting to pick up, it tends to mean that we're late in the game here. And if we don't have that kind of USA rally in session, which is indicative of nice ETF flows, then what do we got? I see a lot of people already rush into the meme coins again, just as price starting to come back a little bit. Like, it's not going to be that easy here. So that gives me pause here.
Okay. Time to pause until we see a couple of these signals start to turn green. Okay. I want to
Dixie too. You never want to write that off when it's running as hot as it is.
I do want to get into the Dixie. I want to talk a little bit about rates a little bit more. Before I do that, again, welcome to everybody. I see a bunch of you in the chat. I see John Wick. Good to see you. Keep your guns at bay, please. I see someone else. I can't pronounce your name, but you're saying Ben is handsome. I think we'll have to agree with that one.
Do it again.
But if you haven't already, definitely hit the like and subscribe button. Share this with anybody that you think wants to have a sophisticated take from a bunch of avatars on the internet. And if you haven't already, consider creating an account at CoinCall, where you can do your options, your perps, and your spot trading for all the majors. It's, of course, the exchange that JJ constantly highlights whenever he's looking at the options videos, which, again, is something else you should check out if you're interested in going down that journey. Definitely a very elegant interface, competitive fees, and of course, easy to follow along with all the knowledge bombs that JJ's dropping. He's currently working on yet another video where he's going to help you with strategies and insights for playing this cycle, something you don't want to miss. So definitely check that out if you're interested in doing options trading. I know some of you, unfortunately, it's not available in your jurisdiction. Nothing we can do about that. But for those who can, definitely a great option for you. No pun intended. All right, let's get into the Dixie here. I feel like this is the canary in the coal mine that just never does anything, right? Currently sitting at 104.13. We've had a bit of a pump. but we're not really seeing any kind of blow off top or capitulation. So JJ, walk us through the Dixie right now. I know it continues to be a risk, but why is it not giving us some kind of stronger signal?
I think it is. So we saw obviously last week the FOMC, it sold off and then it bounced right back. And that's always a worrisome sign to me, is when something has every reason to fall lower, right? Like they basically came out, said, hey, we're not too worried about inflation. All focus are on cuts. And it sold off strongly and then it bounced right back, right? And now we're back above every major moving average. It's looking like it wants to break out above this Bollinger Band here on the daily. We see it above the 50 RSI on the daily, which we were pointing out was key resistance, as well as on the weekly. So basically any time frame you zoom into here, the Dixie's looking pretty strong. And unless we see some kind of reversal back below these lines into the monthly close, I think you take that for what it's worth. I know there's a lot of narratives at the time that, hey, it's just because the Fed's going to be slower to cut rather than central banks. So obviously that's going to strengthen the Dixie. I've seen some of those arguments, and I don't know how well they hold up, because if you look at 2022, the Fed was the slowest to hike, but Dixie obviously went on a massive run throughout 2022. Even prior, it started going on its run in 2021. So the market's always ahead of these things. You don't see them priced in the day of necessarily, like you'd see it priced in earlier. So the fact that it's moving, I take that as a risk off signal until I see some kind of reversal. And I think that's what's telling us. I think we might have gotten a nice exit pump here in the recent days. And as long as Dixie's holding strong, you want to be cautious of that until you really see a firm reversal. So it's just, you take it for what it's worth. When Dixie's running this hot, it's telling you you're in a stage of elevated risk. And we could see that when we look at our Dixie indicator. It's currently firmly in the red. So let me pull that up real quick.
It's a nice interface, by the way.
Thank you. I didn't make it, but
take credit for it where you can.
Let me see. DXY Risk metric. It's just hard to have all these pulled up without my computer crashing. So
the excuses come out. Excuses come out.
So you see Dixie pretty firmly red here, which is a risk off signal historically. You could see these past instances where it's been red. It's been a pretty good indicator that we could be moving lower in the coming weeks or days. Until you see that move into a gray area where some of these technicals reset, it's better off to play it for what it's worth and see it as a risk off signal. Okay,
so you're looking at this as cautious. What is the time in which it's just totally risk off? Maybe you mentioned that, but I didn't catch it. What put a number around it, or at least a range around it, that you're looking for to say, okay, really, it's time to step back.
If we see Dixie break above this Bollinger Band here on the daily chart, you see it moving above, what is this, like 105s or 104.60. I think markets will probably already be in turmoil at that point. So you kind of want to prepare for these moves ahead of time. Like when Dixie moves, obviously, as we saw last week, Dixie sold off, Bitcoin went back up to 68K. By the time Dixie was at the top of this range, Bitcoin was already back at the low 60s. So the moves happen kind of in tandem there. So just be aware of that. If Dixie turns up higher from here, Bitcoin could fall pretty rapidly in short order.
And all your favorite alts are just going to sink like stones. Okay. I want to ask, because, JJ, I think it was last week, you gave a little slap to people looking at the narratives, talking about being, the Fed being outdubbed. You said just focus on the Dixie. But I do know, and we know that the rates are a big component of this. And Ben, we joked about earlier in this session about how Powell won't cut on this next round. But walk us through what you're seeing. We just had the meeting in the FOMC where now everyone's trying to read the tea leaves. They're trying to go through the speech, try and understand, give a better perspective on whether or not when rate cuts are actually going to happen, how substantial they're going to be. You've even mentioned the possibility of them going up at some point, right? Which is something the market hasn't really priced in. What's changed since the last meeting? When is the market actually thinking we may see some cuts?
Yeah, just to be clear, I don't expect rates to go higher. But the conversation around rates and that possibility, whether it's 1%, 2%, 3%, that's sort of what I kind of allude to, of like that conversation needs to just show up. And I think that's where we're headed, and that's where we're progressing. A lot of people, I made reference last week that central banks around the world are already cutting, and this is indicating that the U.S. essentially has to go ahead and do it because everybody else is doing it. But when in reality, like if we go ahead back to 2021, 2022, which is when I pulled up on a chart from Bank of International Settlements. These are all the countries that have already started to cut, and the U.S. is in orange here. Let's see, right in this line right here, and you have all these other countries that went ahead and started hiking well before the U.S. and they're just doing the same. But like, look at the size of this gap. Like, this is over a year, and we're probably coming up pretty close to when various countries did start to cut. Like, and June is sort of the line in the sand for me as far as when the U.S. is likely to start cutting. And if we don't, like, I really got to wonder why. Because the Hawks are winning the room at the moment. They've kind of been proven right. And so all the doves that existed are sort of listening, and they kind of have to go ahead and go with that consensus, because the fact that they wanted to remain higher for longer, and here we are, we've done it, and things are not breaking as anticipated, at least from the doves narrative. So I don't see a break from it, because they have to essentially be proven wrong. And from my understanding, we had the dot plot come out, which is just all the governors giving their rate expectations over the next couple of years. And you can see, at 3%, 4% right here in these years, like, just pay attention to this green box, because that's kind of where like that average is sitting. And this was December 2023, and you can see them shift up. And kind of just note, they're all starting to group together a little bit. So the group as a whole is starting to be more convinced about this higher for longer discussion. And from my understanding of what I've been hearing, I think Anna Wong from Bloomberg was discussing this the other day, is that the recent inflation number was hot, but it was a seasonality version of it being hot. So it was to a degree expected. But if you see March and April coming in hot, that's when I think the room is going to be a little bit worried. And how they respond to that, it's going to be pretty telling, because that's going to affect this June, which is kind of the consensus at the moment. Like, June is the date to keep an eye on, whether you were going to get the cut or we're not. And if we're not, I would have to imagine that the conversation starts to bubble up that maybe we're just going to raise it a little bit. And what does that mean? Should we even consider it? Like, just that whole little confusion, if you will show up, and that will kind of probably be that indication that, hey, maybe we're not going to get it in June. But because the U.S. is pausing on it, you're seeing the Dixie do what it's doing. And I think some of the central banks figured it was going to happen earlier than it actually did. And so they started cutting a little bit too soon. And that's going to hurt them likely in the longer run.
Okay, I just want to summarize what I just heard, which is that right now the default, or the base case, is that they are going to be doing some cuts. But if the inflation numbers are not in fact seasonal, and that we continue to see them run hot, it's going to impact the conversations that we're going to see. And it's possible that they even just raise the idea of stopping or leaving the rates as is, as well as even having more of a discussion of, do we need the rates to go higher to help bring down that inflation?
Yeah, yes and no, but I guess one point of view here is just that Powell is getting into a position where he's going to have to react. Like, he's not going to go ahead and do something ahead of time. Like, if job numbers start to come in a little soft, or inflation starts to come in a little hot, like, he is going to be reacting, and he's not going to be, trying to act ahead of time. And so that might actually become a theme for the rest of the year, if that's what we see happen. I'm curious how investors see that. It's like, oh, okay, so Powell doesn't have control like we expected him to have control. And he's kind of been saying that, like, all of his speeches, like, everyone's saying, oh my God, it's going to be so dovish. This is going to be, and the market rips, but it's really just kind of like a recoil moment. And so everyone's saying that, doing their victory laps on Twitter.
Yeah.
And then it's bearish like the next day, and then everybody else is taking laps, and they're victorious. And it's like, Jesus, like, this is not like a 1 to 2 day thing here, guys. Like, pause the brakes.
It's literally market positioning. Like, you could see it in the way people are positioned, in that we had a ton of shorts enter the day before FOMC, people de-risked, and then for whatever reason, people read it as extremely dovish. You saw the market snap back, and then next day Dixie bounces back. The narrative shifts again. Like, people are just making up narratives to fit whatever view they want, but in reality, it's just positioning. Like, the market's moving in the path of least resistance always. Whatever it finds those max pain points on a day-to-day basis. Like, it's as sure as clockwork. You could see the way the market's positioned.
Yeah, I thought to myself, like, oh, I could totally just pretend to take a victory lap today, but that would be, not very genuine of myself to go ahead and do that, because it's only been a day or two, and that's just not right. And that's not really the mentality that I've projected into the market. And I've kind of had my own bias, if you will, that we're going to have some sort of, now we're talking credit event, right? That's kind of the big, scary boogie monster in the room right now, which is just, we've been keeping these rates for so high, you have to have a little bit of a deleveraging moment, and then that's going to cause liquidity concerns. And I don't want to bring up the whole liquidity crisis we've been mentioning, but it's primed for that whenever it does happen. It's just, are we going to get it? That's just the big question mark in my mind.
And I had a few people ask me about it, like just Dixie's move over the past days. Like, anytime you zoom in on your time frames like this on a day-to-day basis, you're just inviting more randomness, right? So it could have just been a squeeze of Forex traders, in that everybody thought the FOMC was extremely dovish, they got short, and then you see a rebound squeeze. And it could reverse just as easily in the course of the next week. You really have to see how things like the monthly close and whatnot play out to really make a definitive say one way or the other what's driving the current price action we see.
And I'll add in, for those, I don't know how many watchers we got, almost 50 now, is we said there would be a little bit of alpha in the room today, and the alpha is Mr. Pablo, that he has been active this morning, and he tends to coincide with movements on the dollar and the kind of larger macro market at large. So take that for what it's worth. De-risk is really what we tend to tell people whenever we see that sort of activity happen. That doesn't mean you need to go ahead and open up a YOLO short or anything like that. This is, bull markets are not for shorting. It's just about de-risking.
A lot of people learned that lesson the past week.
Yeah. I think
there's a
famous analyst who says, don't F this up. JJ, what was that?
I was just going to, Bitcoin's in a bull market, right? There's kind of no denying the momentum we've seen over the past months. And anytime, as long as it's above the 200-day, obviously have a plan for a 200-day retest, but you never want to be fully de-risked in a bull market, because price can find a narrative any hour of the day and find a reason to pump. So I would caution against anybody seeing things like the dollar moving and whatnot and taking that as a signal to fully de-risk and get caught on the sidelines for the next year because you sold too early. So you have to be prepared to sit on some losses sometimes in a bull market, just knowing it'll inevitably turn around. So have that in mind. Just kind of mind your risk, right? Mind your leverage, mind your risk.
I want to zoom out a little bit, and because I think there's a macro topic that kind of encapsulates some of what we're discussing here, and just get your guys' perspective before we talk about positioning. So I recently listened to Arthur Hayes meet with Pomp. He had a podcast, I think it was last week. And he was talking about his notion of the sovereign debt crisis and what the central banks are going to have to do to try to address the fact that there's way too much debt and there's not enough revenue and growth. And then I was in another forum, and there was a discussion with a VC who was having a discussion with somebody else, more hearsay. But they were asking the same question to somebody in crypto, and their position was they weren't a strong crypto investor. But they're now thinking about getting a sizable position in Bitcoin because they're actually starting to have some concerns with sovereign debt crisis. And then the last point I'll make is that we have BlackRock, which is using that as part of their narrative about, investors like gold as a safe haven, but they also like Bitcoin as the digital version of that. And again, going back to this idea of it's censorship resistant, but also outside of the monetary system. What is the sense that any of these narratives are going to start picking up steam in the next 18 months?
It's a BlackRock marketing engine at work. Who knows how many people they're giving that sales pitch to. And if you listen to some crazy person on Twitter say it, you're going to disregard it. But if it's coming from the largest asset manager on the world, then you take that. It holds a lot more weight, right? So I think you'll see more. There is a scenario where we see kind of Bitcoin work as a safe haven asset. I'd have to actually see it to believe it, because based on historic performance, is that anytime things go risk off in markets in general, Bitcoin goes risk off too. So we have no reason to believe it won't currently, but there is the potential for that. BlackRock's doing a hell of a job marketing it, and they're selling it to a lot of people with a lot of money. So that's something to be aware of, that it's all about perception. If the market perceives this as a safe haven asset, it'll become it's a self-fulfilling prophecy, right? So there is that scenario to be aware of where it could work as a flight to safety in the future.
Yeah, I mean, and that's the point, right? Perception is reality in a sense. And when we think of what is a constant over the last, I don't even know how long, going back, is what's going to happen with, if we're going to be US centric here, as we were talking in the debt issue at large, what is the constant? And it's going to be that they're printing more debt. Like, that's not going to change. And you see sort of, household and credit card debt starting to rise a little bit, but not like to alarming levels by any means. And you see real estate, concerns, especially with commercial real estate, and all of these concerns that have to do with, we need a little bit more money, right? We need potentially some fiscal stimulus to go ahead and help bring some of these households, into being able to get groceries and whatnot. And then you see the recent bill with Congress, what was it, over $1 trillion that had to get printed up. Like that, nothing's going to change there. And so if that's your narrative, you can run that for as long as you want to. And then Bitcoin catches its price, its bid, it starts to run hot. And then you can now just point to the recent printing press spree and say, oh, look, see, this is why it's happening. Okay,
Yep.
Well, why didn't it happen the other day when it okay, well, that doesn't matter, right? Because now my bags are going up. So everybody's happy. So I'm going to go ahead and be the echo chamber and keep that rolling. And I think we just really sometimes need to take a step back and realize that that is a constant. Is that the whole reason that Bitcoin's going to be going up? I don't think so. I think it solves a really interesting problem, which is just decentralized money. And there's not this centralized entity that has to go ahead and tell you that it's $10. This $10 is $10. And it's not the case with this technology here. And we need to keep that in mind. And with Bitcoin, it's going to catch a bid. Okay. If we just abstract everything away over time, I know people don't like stock to flow models, and I'm not going to go ahead and preach that. So don't be throwing, your drinks at me like from the stands or something. But, if we just take a step back, every halving cycle, we kind of have these 4-year cycles, and now it's like part of crypto speak. Now is I literally heard it the other day, like, oh, so and so must not have been doing this because we're about halfway through the cycle. Like it's just now become commonplace. Yet we're then trying to mid-curve this whole concept about, this cut in supply. So it's like, on the one hand, like I get the arguments, but then on the other hand, we're all just starting to adopt it and make it just be part of the normal everyday discussions. And then now we have all the debt that's happening, and now we're trying to point to it every single day. So, all that just to confuse the heck out of everybody, but just keep it in mind, right? It's just perception. Let the marketing engines run. If you want to echo it, I'm all for it.
Yeah, one point, I think that's a good perspective. The one thing I'll add to it is that perception does become reality over time. This narrative can continue to be beaten. I think you've mentioned this several times, Ben. I mean, the proof would be in the interest rates for the bonds, right? If those actually start to skyrocket, or if there actually was a default, which we haven't seen. So before that, it is all narrative and can be very useful narrative for BlackRock and others to be selling this as a position for everyone to hold 1 to 5% in their portfolio. Again, they're all about fees and getting assets under management, so they want as many to come into this as possible. So something to keep in mind. And for all those who are worried about a looming default, I mean, sure, there's possibilities, but I'm not sure you need to YOLO into that trade. So
People
with
still
that,
want
let's
5%.
actually. What's that?
Sorry, people still want 5%, even if the debt's going sky high. They're still going to want 5%.
They're still going to want that 5%. Well, let's talk a little bit about positioning. I want to transition into that. JJ, we'll start with you, go a little bit into options and what you're seeing there, see if there's some potential plays. And then Ben, we'll come back to you. I want to revisit the idea of the DeFi, see if there's anything that you're looking at that maybe you want to share with the good listeners here. And for those who are out there, again, welcome. Love to see all you out there. If you haven't already, hit the like and subscribe button. And since we're going to be talking about options, I'll give you another shout out to CoinCall. which is the beautiful interface that you're seeing that we're highlighting all the time on the show that has competitive fees as well. It's a great place to start your options journey, as well as perpetuals, futures, and of course, spot of the majors. So it's a great place, a very good place to be going in there, because then you can follow around with JJ's videos where he's walking through strategies of how to think about finding good options to purchase, expensive or cheap, and positioning your portfolio as we go through the various cycles, which, as Ben just pointed out, are going to be happening. So you want to be prepared. Now is the time to start doing the your practice runs so that you're prepared for when this market just gets absolutely bonkers. And we're not there yet. I know we've seen the rise in price, but we're not there yet. We're not even close yet. At least that's my perspective. All right, JJ, I want to come back to you. Last week we were talking about how puts were expensive. Didn't really want to be buying those. What are you seeing today? So now that we're back up at 70K, there's been a little bit of liftoff. Where do you think the position is from an options point of view?
I'm looking at the 62K strikes on the April 5th contracts. So these expire next Friday. They're currently trading around $500. And I think you can basically use that 72K during New York sessions as a stop loss here in the coming days. And if we ultimately do see a reversal back towards the lows of last week, these will spike pretty nicely. I think last week we were looking at the March 29th 62K puts, and those got a nice spike after price fell back down from that squeeze that we had on Thursday of last week. So hopefully you took some profit on those. Biggest thing with options is, like, as these things change price rapidly, you have to remember to trade them. They're decaying positions, right? So anytime you see something spike 2, 3, 4x, you have to remember to sell it almost immediately and take those profits off the table, because they are decaying instruments. So I think the same play you could run here again. You buy these 70 or 62K puts expiring next Friday, and you see if we get this washout here in the coming days into the monthly close, and these should give you a nice 2 to 3x return, possibly higher if Bitcoin sees some downside volatility in the coming days here. It's very
Are you buying
low
those?
risk.
Are you buying those naked, or are you hedging them?
No, I would just buy them naked and basically use that 72K level as a stop loss. You get out for a paper cut. Maybe you lose 50 to $100 on these if price moves above there, but your upside on these is, 3, 4, 5x if we get the kind of downside liquidity run in the coming days.
All right. Sounds like an interesting play. High risk, high reward. I like it.
That's the game.
That's the game. That's how options are played. And that's how you can play it if you're over on CoinCall. All right. Anything else, JJ, before we move on and get Ben to chime in here on his positioning?
No, that's all from me.
Okay. All right, Ben. So we were joking earlier today about Ethena and Pendle. I asked you to go in a little bit about DeFi. Are there any projects that you're looking at, or any spaces that you're looking at from a positioning standpoint? Or are you really kind of hands off? I know, I just want to back up a little bit of context. For those longtime listeners, we've been talking about DCAing all last year, about doing some of that positioning. Now we're in the market and it's picked up some steam, right? So just keep that in mind if we're ever talking about positioning on the show, outside of what JJ's talking about options. Like, there is a whole history here that you don't want to ignore. But Ben, with that in mind, what are you looking at right now? Are there new projects? Are you looking at DCing into existing projects? How are you thinking about this market?
I'm looking at the staking yield of Ethereum and its future evolution. I've mentioned it. I wrote an article that was talking about how to go ahead and earn like 40% on your ETH by using Pendle. And it had to do with essentially a swap market, which, one side of the trade, they go ahead and take fixed yield. So you can go ahead and say, hey, you can essentially, I'll be willing to, it's not lending. Okay. I want to confuse that, because a lot of people tend to think that you're lending out your Ethereum, but it's not the case. But you can go ahead and earn this fixed yield of 40%. So then the people that want to go ahead and earn the yield off of that 1 unit of ETH, which part of that yield is eigenlayer points, EtherFi, Kelp, all these other different protocols that are being built on top of eigenlayer, and earning those points as part of that yield. And so that's why it's so high. Go ahead, read that article if you haven't, to better understand it. But to me, that is just beginning. This whole market of Ethereum yield is just starting, because ETH as collateral is going to really grow. If we think of like big moments for that ecosystem, we had ICOs, and that was really just showing how smart contracts can go ahead and run. You deposit funds and then go ahead and allocate tokens accordingly. And it was just really the realization that this new technology is really something to behold. And then eventually they got very scammy and were selling vaporware, and then it had a lot of long tail of assets that never did anything except drop 99%. Then you had kind of 2.0, which was DeFi Summer back in 2020. And that was essentially a new version of fundraising. But in this case, it was bootstrapping capital to a protocol. And in exchange for depositing your capital, you would go ahead and get tokens that were being distributed by that protocol. So it was almost like a new wave of funding, if you will. And so when I think of what's getting ready to happen with Ethereum, it changed its roadmap, a year or two ago, or 2 years ago, I think, to be data availability centric and to be less about trying to scale within its L1. And that was really to allow L2s to go ahead and scale. And now this whole discussion of future L2s coming to surface and renting security, which would mean basically renting ETH, if you will, and then rewarding those that go ahead and let their ETH be used for these purposes. To me, that's essentially like fundraising 3.0 here. And that's where that 3.0 came in at the beginning of the show. So if ICOs was kind of version 1 of fundraising, and then we had DeFi Summer showcase itself as 2.0, to me, this is kind of like the third generation that Ethereum is going to see, where we see a lot of heightened activity. And around that is going to be this market where you can go ahead and take a fixed yield side or a variable yield side. This is a very big market that exists, especially around with banks and trying to be really run with interest rates. And so the way I see this evolving is if a protocol, for example, wants to go ahead and secure because of what's going on with account abstraction, like I can go ahead and make payment for gas for all my users. But what happens if gas just goes through the roof? I don't want to renege on that promise. But I still want to fulfill what I told my users I was going to do. So how do you go ahead and hedge yourself to all that uptick in activity and that uptick in cost in gas? That's where these variable rate markets would come into hand. So you'll go ahead and take that position. And so if priority fees start to skyrocket on Ethereum, the yield that gets paid out is going to rise as well. But because you have that exposure, you go ahead and get those yield payments on a daily basis that offsets the cost that you're going to have to incur with your users. Okay, so this whole market is getting ready to show itself, and there'll be very good use cases that allow protocols. I'm not talking about speculators here. That's a big difference. This is protocols trying to hedge their operations to go ahead and make revenue.
So Ben, I want to jump in here because you just unpacked a lot of information. And I think for those who are deep into rates, deep into trading, more of an economics background, there's a lot of really juicy information. On the flip side of that, I almost wonder if there's a narrative challenge for more of the retail crowd that it doesn't have that background. So is this going to be the case where we're really going to see TradFi, new TradFi, and more of the mature funds really start to use these options to juice their yields before we get to more of a retail-based version that's a simplified narrative?
I don't actually. I think, I joked the other day that I think 95% of users of Pendle don't know how it's working. So I still think you're going to have people use protocols that get mind share, because you see how much APR is being earned by those users. And here we're going to have a case where it's almost similar to yield farming. Yield farming, you go ahead, you deposit your tokens, you get the secondary token as yield, and you make money as long as you can get out before everything comes crashing down, because everything is, as JJ said, it's almost a decaying position. But with these L2s and these rollups, and L2 Beats has a list of all upcoming projects. Let's see, share this tab instead. So right here, you can see upcoming projects. You can see active projects. You got active at 46, upcoming at 34. And most of all of these are being built using L2 tech stacks on Ethereum. And so this represents kind of what I'm mentioning here, which is all of these projects need to go ahead and rent security if they want to go ahead and do it, or they want to go ahead and cover it on their own, but then they're going to have to reward anybody that rents out their Ethereum for these purposes. And so how is that market going to evolve over time? Like, I don't need to be fully aware of a swap market, variable fix, etc. Like, I just need to know, like, I'm depositing a token here. It's going to be used for this other purpose, and I'll be making rewards. And it's not necessarily new. Like, Cosmos does this to a degree. And so I don't necessarily think it has to be a well understood thing. It just needs to be the rewards of what the individual is getting just needs to be explicit.
Okay, that's a good argument for why retail can still get into this. Okay, last question here as we wrap this up. Is it Ethereum? Is Ethereum the play? Is some of these layer 2 protocols the play? How do you think about that?
It just matters your risk appetite. I'm pretty risk averse, if you haven't figured that out by now. I've been in crypto for long enough. I've been burned. I got a burn on every single one of my fingers, just like many are starting to experience now, especially those chasing the meme coin frenzy right now are just learning about. I think, I don't want to say anything, Marconi, but I think the Ordinals project that you were looking at did something recently, but it's just everybody experiences some capacity. And so you just, over time, you get a little bit risk averse. And so in this situation, I'm just going to be watching these markets. Some of the work we're doing on our end is how do you assess the risk of these projects to better understand how risky that yield is that you're looking at. It might say 40%, but how risky is that 40% compared to this other project that maybe is advertising 38%? And so understanding the risk associated with that to go ahead and earn more, in this situation, ETH, stack your ETH, that's the market I'm interested in and working towards. And man, I wish Bitcoin had similar markets like that, because I would be even more active over there just to hedge my ETH maxi talk right now.
Well, we still haven't seen the tattoo, so we'll have to say you're not quite that maxi. All right. Well, with that, we are going to wrap up the show. I want to thank everyone for joining us today. Definitely a lot of alpha here in terms of where the market's going. So if you're thinking about getting into positions, consider what JJ and Ben shared in terms of where some of these risk factors. But JJ, Ben, Lily, thanks for being here. Thanks to everyone who joined us in the chat. Be sure to join us every Tuesday and Thursday where we're breaking down the markets, giving you some of this information so you can figure out the best strategy for yourself. And I'll leave you with my PSA, which is to have some dry powder. This is Marconi White signing off.